Welcome to vTalkInsight, Market Drivers Daily for January 19th, 2026. Powerful growth momentum, an accelerating wave of AI investment, and unusually complex geopolitics are pulling markets in different directions. And today we will unpack how those forces are shaping cross-asset drivers. Economic data continue to point to a solid expansion rather than an imminent slowdown. Recent U.S. indicators, including industrial production beating expectations, a regional GDP tracker running near the high twos, and jobless claims drifting to their lowest four-week average in around 2 years, all reinforce the idea of resilient underlying demand. That backdrop aligns with commentary that consumer spending remains robust, particularly among higher-income households, which helps explain why equities have so far absorbed higher rate expectations without a sharp risk-off move. Market leadership is also broadening in a way we have been tracking over the past few days. Small-cap U.S. equities are drawing renewed interest, supported by expectations for faster domestic growth, some policy support for lower-income segments, and improving earnings revisions. Cyclical areas such as industrials and infrastructure are increasingly in focus, helped by fiscal incentives and accelerated depreciation, while global equity markets show impressive breadth, with all major regions now trading above their long-term trend measures. In Asia, strength in markets like South Korea and a more constructive tone on China and Japan support a wider regional reflation narrative, moving the story beyond a narrow mega-cap tech rally. Within sectors, several growth narratives are re-accelerating. Luxury demand is stabilizing as wealthier U.S. consumers keep spending and conditions in China look less fragile, with large groups using flagship brands as liquid proxies on a potential sector recovery. Consumer health and nutrition is another pocket of strength, with weight loss therapies driving interest in high-protein, low-calorie foods, and some brands even facing stockouts as demand outpaces supply. Innovations like fat-mimicking triglycerides are enabling new product categories in sports nutrition and snacks, hinting at further disruption across consumer packaged goods. The growth impulse is also visible in credit and corporate activity. Regional and smaller banks are benefiting from a steeper yield curve and recovering loan demand, particularly as small and mid-sized firms move from caution to measured expansion. In Europe, major investment banks are expanding advisory teams on the expectation that a backlog of delayed transactions and more benign financing conditions could drive a pickup in mergers and acquisitions into 2026. At the same time, stronger industrial production and earnings beats in cyclicals are giving investors more confidence that the recovery is not confined to a handful of megacaps. Emerging markets, and India in particular, round out the growth picture. India is repeatedly highlighted as a structural story, with 6 to 7% real growth, a young, urbanizing population, and rapid expansion in electronics and semiconductor-related employment supporting expectations of attractive medium-term returns. Yet this positive backdrop comes with late-cycle features. Commodities and materials are outperforming, capacity in some areas is tight, and there are questions about how much of the expansion is driven by wealth effects and fiscal support rather than broad-based income gains. Global manufacturing overcapacity, especially from China, plus anticipated productivity gains from AI, could exert disinflationary pressure over time, complicating the policy mix. For investors, that combination argues for close attention to the durability of small-cap and cyclical leadership, the evolution of wage growth, and how quickly the current growth phase hands off for policy tailwinds to organic demand. The AI story is transitioning from hype to a full-scale investment cycle. Corporate spending on AI is expected to roughly double next year compared with the previous one, and surveys suggest the overwhelming majority of chief executives plan to keep investing even when near-term returns are uncertain. Hyperscaler capital expenditure expectations for 2026 have already been revised higher, from roughly 30 to the mid-30s in percentage growth terms, and there is talk of AI-related capex reaching into the trillions over the coming years. Foundry leaders are responding, with one major chip manufacturer lifting capital plans into the low to mid-50 billions, supported by firm commitments from customers such as leading GPU designers and smartphone makers. This surge in spending is being felt across the semiconductor ecosystem. Demand for AI-related chips is outstripping current supply, with fourth-quarter revenues at leading firms hitting new highs and prompting fresh rallies in equipment makers and memory names. Analysts see scope for smaller technology companies to outperform large caps as the build-out moves beyond a handful of mega-cap beneficiaries and into components, tools, and specialized software. Importantly, many in the market argue that AI valuations are still grounded in strong earnings delivery, reducing fears of a pure bubble, even as concentration in a small group of growth leaders remains a key risk to monitor. Beneath the headline numbers, the competitive landscape is fluid. Investment is most advanced in technology and financial services, but consumer goods companies are ramping up budgets as they look to embed AI into marketing, logistics, and product design. Executives in Asia tend to approach AI as a growth engine, while many Western peers frame it partly as a defensive move to avoid falling behind. Evidence suggests that firms whose leaders personally devote meaningful time to AI training see better outcomes, highlighting how management focus can translate into measurable productivity gains. At the same time, there's uncertainty over which players will capture the most value, given intense competition between incumbent software vendors, AI-native startups, and large model providers, as well as highly profitable platforms already reporting multi-billion-dollar revenue run rates. Energy supply is emerging as the critical constraint on the AI build-out. Electricity demand from data centers is now a primary driver of wholesale power prices in some U.S. grids, and wholesale markets like PJM report that server farms are overtaking other inputs as the main upward pressure on tariffs. In states such as Texas, hyperscalers are competing fiercely for incremental capacity, while grid connection delays and permitting scrutiny reflect growing concern about bill impacts and system stability. In response, policymakers are floating proposals for technology companies to fund new power plants, and bipartisan pressure is building to address the link between AI infrastructure and household energy costs ahead of upcoming elections. By contrast, China's relatively ample electricity supply is seen as a strategic edge for its AI ecosystem, underlining how energy abundance or scarcity could influence where future compute clusters are built. On the application side, concrete use cases are starting to scale. In healthcare, AI-enabled prescription renewal services are cutting wait times from weeks to near instant approvals in some pilots, with operating costs low enough to support transactions priced at just a few dollars. These platforms are being designed with multiple safety checks and human oversight, aiming to reassure regulators while expanding access, especially in rural areas where physician coverage is thin. Beyond healthcare, AI is expected to augment, rather than replace, highly specialized analytical roles in private markets, reinforcing the need for advanced human skills alongside automation. Still, there are headwinds. Rising electricity costs and long-term power contracts threaten margins for highly leveraged AI players. Legal disputes between prominent industry figures introduce headline risk for the theme, and there is a growing recognition that without policy responses, the wealth created by AI could widen inequality. Looking ahead, key signposts will be the next wave of earnings and CapEx guidance from AI-exposed firms, developments in power market regulation, and any shifts in antitrust or data rules that could reshape who ultimately wins the AI race. Geopolitics remains the main wild card in the macro narrative, even as markets sometimes look past it. In the Middle East, the deployment of a U.S. carrier group back into the region, alongside expectations of further assets, underscores ongoing tension with Iran. Iran's Revolutionary Guard has evolved into the dominant force across much of the country's security and economic system, making any regime change extremely complex and raising the risk that sanctions or limited strikes have unpredictable spillovers. Iranian oil exports of around 1.5 million barrels per day, combined with the fact that roughly a fifth of global crude moves through the Strait of Hormuz, leave a clear channel through which escalation could send energy prices sharply higher, even though current supply balances are relatively comfortable. Commodity markets reflect this uneasy balance between risk and cushion. Oil prices, while off recent peaks, remain above early year levels as traders keep a geopolitical premium in place, but ample global supply gives policymakers some room before any disruption becomes acute. At the same time, volatility is notably higher in commodities than in rates or major currencies, with investors using gold and, in some cases, crypto assets as hedges against tail scenarios. One large investment bank even projects gold prices could reach the low 5,000s per ounce by year-end, citing central bank diversification and geopolitical uncertainty. And recent stress in Iran has coincided with a spike in local Bitcoin withdrawals to private wallets. Beyond the Middle East, the Arctic has become another symbol of shifting power dynamics. Tensions around Greenland had escalated as the U.S. pursued a more assertive stance, prompting European NATO allies to increase their military presence. More recently, though, diplomatic engagement between Washington, Copenhagen, and Nuuk has helped move the issue from public confrontation into working-level talks, with a new group meeting regularly to manage disputes and reduce miscalculation risk. Even so, scenarios in which the euro, rather than the Danish currency, comes under pressure in a severe Greenland-related crisis illustrate how European security concerns can feed back into FX markets. These flashpoints sit within a broader shift toward regionalization and hardened blocks. Companies are reconfiguring supply chains away from purely global, just-in-time models toward more local or regional setups, in response to tariff uncertainty, industrial policy, and security considerations. China's dominant position in battery materials and processing is viewed as a long-term bargaining chip in electric vehicle supply chains, while energy trade frictions, such as questions over Canadian crude flows to the U.S., add to the sense of vulnerability. Defense is a clear winner from this environment. European military budgets are rising, defense contractors have seen multi-year share price gains, and large-ticket weapons programs and even billion-dollar-plus security-related mergers suggest rearmament is now a structural, not cyclical, theme. Interestingly, markets are not treating all of this risk equally. Safe haven metals and some commodity markets are volatile, and portfolio managers report trimming risk ahead of long weekends on concern about unexpected headlines from Iran or Japan. Yet rate volatility and major currency moves remain subdued, and many participants still cite central bank policy as the primary driver of asset prices, effectively discounting some of the geopolitical tail risk, including in places like Venezuela. This leaves a backdrop where counter-trend moves and headline-driven dislocations can be meaningful for relative performance. Key watch points now include any disruption around Hormuz, the trajectory of U.S. actions toward Iran and a reaction from China as its main crude buyer, progress of Arctic diplomacy, and how quickly defense and infrastructure spending filters through to earnings in exposed sectors. Those geopolitical currents will continue to interact with the growth and AI themes we discussed earlier, shaping both the level and composition of risk premia across markets. To wrap up, growth momentum is holding up and broadening into small caps, cyclicals, and select emerging markets, even as late cycle signals emerge in commodities. The AI investment wave continues to build, with semiconductors, infrastructure, and power markets at the core, but energy costs, competition, and policy scrutiny introduce new sources of dispersion. On top of that, geopolitical risk from the Middle East to the Arctic keeps a floor under oil and safe haven demand, while rates and FX still price a relatively calm macro path. Staying alert to rotations across sectors and regions, to the evolution of AI capex and power constraints, and to headline-driven swings in commodities will be key for navigating the weeks ahead. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.